Okay, good morning. Good morning. So today we are going to start with the last part. We'll finish this part and finish the chapter. Okay. See, exemptions are there. Okay. We are going to talk about the first exemption. Exemption under the head capital gains. Okay, sir. So under these exemptions, first exemption is section 54. Which exemption? Section 54. Now in this exemption, now what happens? That if there is an individual or HUF, meaning this exemption is available only for individual and HUF. Only individual HUF can take the benefit of this exemption. Okay. If an individual or HUF is there, that individual or HUF has transferred what? A residential house property. Which house property? See, house properties can be commercial properties also, yes or no? But we are supposed to transfer any residential house property only. Residential. Now on transferring the residential house property, you will have long-term capital gain. Which gain? So the long-term capital gain arising on transfer of residential house property in the hands of individual or HUF, this long-term capital gain will be exempt. Under which section? Under section 54. Okay. So if you want to claim this exemption, you will have to make an investment. You will have to make investment. Where you are supposed to invest? Another residential house property. Yes or no? So this residential property gain has to be invested in another residential property. Meaning that you have to purchase or you have to construct another residential property. And whatever cost is incurred to purchase or construct that residential house property, that will be assumed as if that cost is met by this long-term gain. Understanding? So the cost of purchase or cost of construction of that new residential house property will be assumed as if that is met by this long-term gain. And accordingly, this long-term gain will be exempt. Understanding? What if the long-term gain is 5 lakh rupees? How much? And the cost of the new property is 4 lakhs. Then out of 5 lakh, 4 lakh is spent out of this 5 lakh. Yes or no? So out of this 5 lakh, how much will be exempt? 4 lakh. And remaining 1 lakh will be taxable. Yes or no? Now for example, the cost of the new property was 5 lakhs. Then it will be assumed that the cost is met by this 5 lakh. Yes or no? And accordingly this 5 lakh will be exempt. Understanding? For example, the cost of the new property is 7 lakhs. Then in that 7 lakh, 5 lakh of this gain is invested. Yes or no? So accordingly full 5 lakh will be exempt. So if the investment meaning the cost of the new property is more or equal to capital gain, full capital gain will be exempt. Assuming that the entire capital gain is invested. Okay. And if the cost is less, it will be assumed that out of this capital gain, only this much capital gain is invested. So that much capital gain will be exempt and the balance will be taxable. Understanding? So how much exemption you are going to get? A, the amount of your long-term capital gain, or B, the amount of investment. Investment means cost. Okay, no? Cost of what? Of new residential house property. Now new does not mean you have to buy it brand new. Huh? You can purchase that property in resale also. If somebody is selling the property and you are buying that property, even for you it will be considered as new residential property. If in some new construction also you are buying the property, that means it is a new property. For you it should be a new property. Yes or no? So, cost of new residential house property. Now see, investment or long-term gain, whichever is lower, that will be exempt. Now this investment in new residential property means what? You have to purchase or you have to construct. So whatever cost of the purchase is there, whatever cost of the construction is there, is made out of this gain. But this purchase, how many properties should be purchased? How many properties should be constructed? So purchase of any one residential house property in India. Construction of any one residential house property in India. So if you have purchased multiple properties, if you have constructed multiple properties, yes or no? So will it be considered that in all those properties the investment is made out of this gain? No. Any one residential property, the cost is made out of this long-term gain. It will be assumed. Yes or no? So it will be assumed that out of all those properties, cost of any one residential property is made out of this gain. Okay? And that property should be in India. That property should be in. Now see, if you are purchasing a property or you are constructing a property, the purchase should happen within 1 year backward. 1 year backward or 2 years forward. Construction should complete within 3 years forward. Meaning this is the time given to purchase or construct a residential property. If you want to claim this exemption, you have to make sure that the property which is purchased in India or constructed in India has been purchased within this time, has been constructed within this time. So if the property is purchased within 1 year backward, 1 year backward means what? You had this old property, yes or no? So you have to check the date of transfer. Date of transfer of this property. 1 year immediately preceding to date of this transfer. 1 year immediately before date of this transfer. Or 2 years immediately after the date of this transfer. Or 3 years immediately after the date of this transfer. So the date on which you have sold your original property, old property. The date of transfer of your original property, old property, yes or no? Within 1 year backward, meaning within 1 year prior to this date. 2 years forward means within 2 years after this date, yes or no? 3 years forward means within 3 years after this date. So whatever properties are purchased within this time, whatever properties are constructed within this time, it will be assumed that their cost is met out of capital gain. Their cost is met out of this capital gain. Yes or no? But out of all such properties, any one residential property in India will be considered that the cost of that property is met out of your long-term gain. And the investment in that property would allow you to take the exemption under section 54. Understanding? How many properties? So within 1 year backward and 2 years forward, you have constructed you have purchased 3 properties. So out of all those 3 properties, you have to check which properties are purchased in India. So out of 3, only 2 were purchased in India. Then the third one will be ignored, automatically ignored. Okay, no? So investment in that property cannot be assumed that it is out of this gain. Ignore that. So what are you going to do? What are you going to do? You are supposed to consider only those 2 properties. See, within this time, whatever purchase has been made. Within this time, whatever purchase has been made. So how many purchased within this time? 3, sir. 3. Date of transfer of the original property, 1 year backward. Within 1 year backward and 2 years forward. How many properties are purchased within this time? Example, 3. One was purchased outside India. Ignore that. Other 2 properties are there. But the investment in both the property, cost of both the properties is not made from this gain. Cost of any one residential property is made out of this gain. So which property would you like to consider? The property having more cost, so that you can take more exemption. Understanding or not? Now for example, within 3 years, what did I say? You have constructed 3 properties. How many properties? So from the date of transfer of your old property, from the date of transfer of your old property, from that date within 3 years. After that date, within 3 years, 3 properties are constructed. And all the properties are constructed in India. Then out of all those properties, any one residential property constructed in India. The cost of that property is met out of this gain. It will be assumed. Understanding? So sir, one property purchase, one property construct. Can I do that? One property purchase as well as one property constructed. Then it will become 2. Your investment should happen in 1, either in purchase of 1 or in construction of 1 residential property. So there is something in between. Or either purchase of 1 property or construction of 1 property in India. The cost of that property will be assumed as if it is met through this gain, and accordingly this gain can be exempted based on the investment in that property. Understanding? Now see, the time which is given, no, the time limit which is given, because of this is not a small time, okay, no, this is a good amount of time. Now this can put the assessee into some trouble also sometime. Trouble means genuine problem. See, I am drawing a small timeline in front of you, okay, no? To make you all understand that what I want to say. For example, what is your previous year? Tell me. 25? Your previous year is 25? 26, right? No? Okay. So this is 1, 2, 3, and this is 4. So your previous year is 25, 26. For example, in this previous year, on 9th of July 2025, this was the date of transfer. Date of transfer of your Bangalore property. You have a property in Bangalore, okay? So the property in Bangalore, you have sold that property. When did you sell? So can I say during the previous year 25-26, on this date you transferred your Bangalore property, and Bangalore property was your long-term capital asset. So on transfer of that Bangalore property, what happened? Long-term gain is arising. Now you want to claim the long-term gain of this property as exempt. You want to claim this long-term gain as exempt. So on this date, your Bangalore property, Bangalore residential house property was transferred, right? Now, since this is the date of your transfer, this is the date of your transfer, and this property, residential property, on transfer of this residential property, long-term capital gain is arising, and you want to claim the exemption of this long-term gain. So for that, you have to purchase or you have to construct. So within how much time you should have purchased a property or you should have constructed a property? 1 year backward, 2 years forward, or 3 years forward from this date of transfer, yes or no? So we are supposed to see 1 year backward. So 1 year backward, can I say it will be 9th of July 2024? 2 years forward, can I say it can be 9th of July 2027? 3 years forward, can I say it will be 9th of July 2028? So if you want to purchase now, so you have to purchase within this time. You have to purchase within this time. Okay, no? Within 1 year backward. Or if you want to purchase, you have to purchase within this time. 2 years forward. Yes or no? 2 years forward. Or if you want to construct, you have to construct within 3 years. 3 years from date of transfer. Getting my point, what I am trying to tell you? Now see, this is the time within which you should have purchased. This is the time within which you should have purchased. Understanding or not? P for purchase and this is P for purchase. And this is the time within which you should have constructed. You should have constructed. Okay, no? Now see, they are giving you good time to purchase. Now, whatever property you have purchased within this time, can I say from this time to this time? That property which you have purchased within this time, the cost of purchase of that property is met out of this long-term gain. Whatever property you have constructed within this time, the property which is constructed within this time, the cost of construction of that property is assumed as if it is made by this long-term gain. Understanding? Hence, out of this long-term capital gain, this much amount or this much amount can be exempted. Getting my point? Hello? The cost of purchase, to that extent your capital gain can be exempt. Now see, there will be a practical problem. Why? Because this is your previous year 25-26. And for this year you have to file a return of income also. And in that return of income, you are going to show this capital gain also. And out of that capital gain, you want to claim this exemption. Understanding, no? So tell me, what will be the due date of filing return? This will come in the immediately next year, either 31st July or 31st October, as the case may be. So for example, your due date of filing ROI. Your due date of filing ROI. This is due date of what? Filing your ROI, and this due date is 31st of July 2026. On or before this due date, you have to file your return. Okay. So what am I going to do? I am going to draw one line over here. Okay. Now this is your cutoff date. Now can I say on or before this date? On or before this date, you have to file your return. Return for previous year 25-26. In that return, you will have to show this capital gain also. And out of this capital gain, if you want to claim the exemption in the return, so on or before the due date of filing return, purchase should have happened. Only then, based on that purchase, you can claim the exemption out of the capital gain in your return. Yes or no? Or construction should have happened within this time. Only then, based on that investment in the construction, you will be able to claim exemption out of your capital gain in the income tax return. Yes or no? But what if you could not purchase and you could not construct on or before the due date of filing ROI? Will you have to show this long-term gain in your return? Yes. But out of that long-term gain, will you be able to claim this exemption? Why? Because till the due date of filing ROI, till the date of filing your ROI, you are not able to purchase any property or you are not able to construct any property. So if the purchase is not made, construction is not made till the date of filing your return of income, so in that return your entire long-term gain, it will be taxable and you will not be able to claim any exemption, even if some time is still remaining for purchase and some time is still remaining for construction. Practical difficulty or not, tell me. So to remove this difficulty, so that you can claim your exemption in that same return, yes or no, from that capital gain, there is another option given. Third option is also given. What is that third option? They are saying that deposit, what? Deposit in capital gain deposit account. Capital gain deposit account with any scheduled bank. That deposit will also be considered as if you have invested in the purchase or construction of the property. But that deposit you have to make. On or before. On or before what? Due date of filing ROI or actual date of filing your ROI. Actual date of filing your ROI, whichever is earlier. So for example, your due date was 31st July and you are filing your return on 31st August. Then 31st July or 31st August, whichever is earlier, 31st July. So on or before 31st July, the deposit should be made. Yes or no? For example, your due date is 31st July 2026 and you are filing your return on 25th July 2026. Then 31st July or 25th July, whichever is, so on or before 25th July, you should have made that deposit. So the deposit which you will make on or before the due date of filing your ROI, the deposit which you will make on or before the due date of filing your ROI or actual date of filing ROI, whichever comes earlier, that deposit also will be considered as if the money is invested, as if the gain is invested in the new residential property. And based on that deposit also, you can claim the exemption from your capital gain in your return of income. Getting my point? Hello, sir. So for example, within this time, you were able to purchase. Then there is no problem only. Cost of purchase is met out of long-term gain. Based on that, you can claim the exemption. Yes or no? Or within this time, you were able to construct a property. Then also no problem. Then also no problem. Cost of construction of that property is assumed as if it is met from long-term gain. And based on this, you can claim the exemption. But what if purchase could not be made, construction could not be made on or before the due date of filing your ROI or actual date of filing your ROI, whichever comes earlier? What if the purchase or construction could not happen? Then at least deposit the amount in the CGD account. So go to any bank, tell them that you want to open a CGD account. Any scheduled bank, you are supposed to go nationalized bank, yes or no? Just like SBI and Bank of India, Punjab National Bank, yes or no? Go to any of such banks and tell them that you want to open a capital gain deposit account. I want to deposit my capital gain, which I want to use later on to purchase a property or construct a property, because some time is still remaining for purchase and construction. Yes or no? So just now go to any bank and tell them you want to open a savings account, no? Current account, no? Then FD account. Which account? Capital gain deposit account. So they will give you a form. Capital gain deposit account form. Your name, details, everything will be filled. And the moment you will open that account, in that account, deposit the money. So the money which you will deposit in that account will be assumed as if that money is your capital gain invested in the purchase or construction of a residential property. So the gain which you will deposit here, it will be assumed. Money which you will deposit here will be assumed that it is deposited out of your capital gain, yes or no? And also invested in purchase or construction. From this money, cost is met. It will be assumed, and based on that deposit also you can claim the exemption. Understanding or not? But make sure, once you will withdraw that money from the CGD account, now you will have to use that money for purchase or construction, and that purchase or construction must be completed within the given time, available time. Yes or no? So, the money deposited in CGD account, withdraw that money, and that money within the balance time must be used for purchase. So, within the balance time, meaning on or before 9th of July 2027, purchase should happen. Out of this deposit, money should be withdrawn and the purchase should happen within this time. Yes or no? Money has to be withdrawn, and out of that money, construction should happen. Construction should happen within this time, on or before 9th July 2028. Will you remember this? But sir, what if the amount which you had invested in CGD, amount which you had deposited in CGD, now based on that amount which you have deposited, you have already got the exemption under section 54. Assuming that the deposited amount is invested in what? Purchase or construction of a new residential house property. What if later on you withdraw that money and you use that money for any purpose other than purchase or construction? Then the money which is withdrawn and misutilized, the money which is withdrawn out of your CGD account and misutilized means utilized for any purpose other than purchase and construction. That is misutilization. Yes or no? That entire amount of misutilization will be treated as your deemed long-term capital gain for the year in which that amount was misutilized. Because the amount which you have misutilized is out of this deposit, and this amount which you have deposited, this much amount we have already exempted you. This much amount of gain we have already exempted you. So the amount which you have deposited, to this extent we have given you the exemption under section 54. Now if you withdraw this amount and not using this amount for purchase or construction, using this amount for some other purpose, so the amount which is misutilized, that entire amount which you have already claimed as exemption from us under section 54, that amount will now be treated as your deemed long-term capital gain. Understanding? In which year? In the year in which it is misutilized. Will you remember this? Now pay attention. 9th July 2028 is the last date by which your money should have been, the deposit should have been utilized. Utilized for what? Purchase or construction. So for example, 9th July 2028 has come, and now you check your CGD account, and your CGD account is still showing some balance. So money which you have deposited in CGD account, that entire money, to that extent we have given you exemption. Yes or no? The money which you have deposited in CGD account, to that extent, to that entire extent we have given you what? Exemption of your capital gain. And that time you promised that within the balance period of 2 years or 3 years, you are going to use this deposit for the purpose of purchase or construction. So when you deposited money, that deposit amount, to that extent the capital gain was exempted. Yes or no? And that time you promised that you are going to use this money on or before 9 July 2027 for purchase. And you are going to use that money on or before 9 July 2028 for what? Construction. Now 9 July has come and still there is some balance in your CGD account, meaning unutilized amount in the CGD. The amount which remains unutilized in the CGD account, for this also you had claimed the exemption from us, no? So that amount you had promised that you are going to use for purchase or construction. 2 years have gone, 3 years have also gone, and this amount is still remaining in your CGD account. Getting my point? So meaning that the amount which remains unutilized in the CGD account is neither used for purchase nor used for construction. So even that amount will be treated as your deemed long-term capital gain. In which previous year? In the previous year in which the period of 3 years has expired. Meaning previous year 28-29. In that year, the amount of unutilized balance of your CGD will also be treated as your deemed long-term capital gain. Will you remember this? Will you remember this? Sure. So tell me, are you an individual or HUF? Have you transferred your residential house property? Long-term gain is arising. So that long-term gain can be exempted under section 54. How much? The amount of your long-term gain or the amount invested in the new residential property. New residential house property. Yes or no? So whatever amount of capital gain is there or whatever cost of the new property is there. Yes or no? Cost of purchase of the new property or cost of construction of the new property. Whichever is lower. To that extent, the capital gain will be exempt. To that extent, your long-term gain will be exempt. Getting my point? But for this, your investment should happen in new residential house property, meaning you should purchase a new residential house property or you should construct a new residential house property. Purchase cost of the new residential house property, construction cost of new residential house property is met out of long-term gain. It will be assumed as if that purchase cost or construction cost is met out of your long-term gain, provided the property is purchased in India, constructed in India, within this time, So within the available time, whatever properties are purchased or constructed in India, out of all such properties, any one residential property, the investment in that property will be assumed as if it is out of long-term gain. Understanding? Cost of purchase or cost of construction of that property which is in India and which is purchased or constructed within the given time will be assumed as if it is made out of this long-term gain. Understanding? And based on that purchase cost, based on that construction cost, meaning investment, you are going to get the exemption. You are going to get the exemption under section 54. How much exemption? The amount of purchase cost, amount of construction cost, meaning amount of investment or amount of your capital gain, whichever is lower, that much will be exempt from your long-term gain. Understanding? So what if the investment, what if the purchase cost or construction cost of the new property was higher? Meaning entire capital gain is invested, in entire capital gain exempted. Yes or no? What if that amount is equal to capital gain? Then meaning that entire capital gain invested, entire capital gain exempted. What if that amount of investment is less than your long-term capital gain? Then it will be assumed that the capital gain to the extent of that investment only is invested. Yes or no? And the balance amount of capital gain which could not be invested in the purchase cost or construction cost will be taxable. Understood? But this you have to make within this time. But see, since the time limit given is more, so there is a possibility that before this time limit gets over, before that only your due date of filing return will come. And what if on or before the due date of filing your return, you are not able to purchase or you are not able to construct a property, then you are given one more option. What option? Deposit in CGD account, capital gain deposit account. And whatever amount you have deposited in CGD account, you have to deposit it on or before due date of filing the ROI or actual date of filing your, whichever date comes earlier. On or before that date, you have to deposit an amount in CGD. So the amount which is deposited in CGD is as good as your capital gain, long-term capital gain invested in purchase or construction. So to the extent of that amount which is deposited, you are going to get the exemption. Your capital gain, long-term capital gain, to the extent of that deposit also will be exempt. But now you'll have to make sure that you will use that deposit. Where? Purchase of one residential house property in India or construction of one residential house property in India within the given available time. Yes or no? So what if the amount in CGD account, the amount deposited in CGD account is withdrawn and utilized for this purpose? Then very good. You are supposed to withdraw and utilize for this purpose only. Yes or no? But what if you withdraw and utilize for purpose other than purchase or construction? That is known as misutilization. That is known as, and what will happen in the case of misutilization? The amount withdrawn from the CGD account and misutilized, that much amount will be deemed long-term capital gain. For which year? The year in which it is misutilized. Yes or no? Now what if the period of 3 years expires and still there is some balance in your CGD account? That balance, to that extent you have already claimed the exemption from us. Yes or no? Saying that you are going to use this amount for purchase or construction. Bloody 2 years have gone, 3 years have also gone, and still this amount is appearing in your CGD account, meaning the amount which is still there in your CGD account was neither used for purchase nor used for construction. Hence that amount is still there in your CGD account. Yes or no? So even that amount is known as unutilized balance. Known as unutilized balance in the CGD account. That amount will also be treated as your deemed long-term capital gain. In which year? In the year in which the period of 3 years expire. So in that year, the amount of unutilized balance in the CGD account will be deemed to be your long-term capital gain. Why deemed as long-term gain? Because exemption for long-term gain was given. So if the long-term gain was exempt based on this deposit, so now that deposit is unutilized, so should be taxable as deemed long-term gain only. Yes or no? Understanding? Now last thing. Last few things out of that. For example, you have purchased your property, or you have invested the amount in the CGD account, and from that amount you have purchased the property. Okay? Or you have constructed the property. Or you have deposited an amount, and from that deposit you have withdrawn an amount, you have constructed a property. So that is a new property. That is a new property, residential property. Okay, no? That new residential property, from the date of its purchase or from the date of its construction, the date on which the new property is purchased, the date on which the new property is constructed, construction completed, yes or no? From that date, for the next 3 years, it cannot be transferred. Because based on the investment made in this property, your capital gain has been exempted. Yes or no? Purchase cost of the new property, construction cost of the new property, to that extent your capital gain we have exempted, yet, yes or no? So whatever cost of this property is there, investment in the cost of this property, to that extent your capital gain is exempted, no? Now if you sell this new property within 3 years, within, meaning the lock-in period of the new property, lock-in period of new property is 3 years. Within 3 years, if you sell, within 3 years from the date of purchase of the new property, within 3 years from the date of completion of construction of the new property, within those 3 years you are not supposed to transfer that new property. That is a lock-in period. Minimum for that much period you should be holding that property, yes or no? But what if within those 3 years you sell the new property also? Then the exemption which we gave based on the investment in this property, yes or no, will be revoked. Will be revoked. And how that will be revoked? Simple. The cost of that property, which was to that extent your capital gain was exempted, no? That much cost will be reduced. To that extent will not allow you the cost. If the entire cost of the property was allowed as exemption under section 54, entire cost we are not going to give you as a deduction. Out of the cost, some cost was given as exemption, yes or no? To that extent the cost will be reduced. So the cost of the new property will be reduced to the extent of exemption which was allowed under section 54 if the new property is transferred within 3 years. That way your exemption which you got by investing in this property will be revoked. And how that revocation will be done? To that extent the cost will be reduced, to the extent of which the cost was allowed as exemption under section 54. Will you remember this? Everyone? Sure, sir. I'll give you examples with numbers also, huh? Don't worry. Okay. But right now, you learn this provision properly. Remember the provisions, okay? Now next one, tell me. Yes. In how many properties you are supposed to invest? Any one residential property in? Any one residential property in? Must be purchased or must be constructed within the given time. Within the given. Now there is a catch here. If the long-term capital gain, meaning you're transferring your old property and your long-term capital gain, yes or no, from the old property. If long-term capital gain on transfer of original residential house property means old residential house property, was less than or equal to 2 crores. The gain should be less than or equal to 2 crores. Yes or no? Then investment in any 2 residential house property in India can qualify for exemption. Investment means cost. Yes or no? Cost of any 2 residential house properties in India can qualify for exemption. So for example, within this time, you have purchased the properties. Yes or no? 2 properties purchased. The cost of purchase of 2 properties within this time is met out of your long-term gain. It will be assumed as if the cost of those 2 properties is met out of your long-term gain. Not 1, but 2. Within this 3 years, you have constructed some properties. Yes or no? Hello, sir. Within this 3 years, you have constructed some properties in India. So out of all those properties, cost of construction of any two property is met out of your long-term gain, and based on that investment in two properties, you can claim the exemption. But for that, your long-term gain of old property should be 2 crores or less. Understanding? So you can claim the exemption by investing in how many properties? Two properties. But that exemption will be available for a long-term gain which is up to 2 crores, and investment in two properties can be considered for the purpose of claiming the exemption. Getting my point? But this option will be once in a lifetime option. This option will be given once in a lifetime option. Meaning, you cannot claim this exemption by investing in two properties again and again. Again and again your gain will be 2 crores or less, 2 crores or less, and again you are purchasing two properties and we are giving you exemption. No. Only once in your lifetime. So, this year, your Bangalore property you sold. Yes or no? How much was the gain? 1 crore 80 lakhs. How much was the gain? 1 crore 80 lakhs. And now you are purchasing three properties. One in Hyderabad, one in Chennai, and one in Mumbai. Three properties you are purchasing. Possible? Within that given time, you are purchasing three properties. So which properties? All the three properties? Any one property? Or you have the option to take the investment of two properties. So any two properties out of those three. Hyderabad, Mumbai, Hyderabad, Chennai, Mumbai, Hyderabad, or Mumbai, Chennai. Any two properties. So investment in the purchase or construction of any two residential properties is made out of this long-term gain of 1.8 crores, yes or no? And accordingly, to that extent your long-term gain can be exempted. But this option if you exercise in this year, and claim the exemption out of your Bangalore long-term gain, yes or no? Then this option will not be available again in your lifetime. Once in a lifetime option. So in future, whenever you will sell your another residential property, and that property, even if the long-term gain is up to 2 crores, can you claim the exemption from that property? Yes! But now the investment can be made only in one property. Investment made in two properties cannot qualify for exemption under section 54 later on. Why? Because you have already claimed the exemption under section 54 by investing in two properties in your lifetime once. This is a once in a lifetime option. Once you have claimed exemption by investing in two properties, this investment in two properties option will not be available later on. Even if later on the gain is up to 2 crore of any residential property. Yes or no? Understanding? So tell me, right now if you claim this exemption by investing in two properties, can you claim this section 54 exemption later on? Yes, you can claim. Later on, even if your long-term gain of another property is up to 2 crores, but now you don't have option later on to invest in two properties to get the exemption of that gain. Understanding? Maximum investment can be one property. Understood? Should I move? Now see. Now, investment in new residential house property. Investment means what? Cost. Cost of new residential house property. Yes or no? Was 14 crores. 14 meaning you can claim your exemption if your long-term gain is 14 crores. Up to 14 crores you can claim the exemption. Yes or no? So what they are saying, if your investment in new residential house property, meaning the cost of the new residential house property is more than 10 crores. More than. So, investment in new residential house property, meaning the cost of new residential house property is more than any investment, meaning cost over and above 10 crores shall be ignored. Shall be ignored. For example, you have one property in Mumbai. You sold that property. Old property was in Mumbai. You sold that property. Capital gain was 18 crores. Long-term gain, how much? 18 crores. Huge property, very valuable property. You sold that property and how much long-term gain you earned? 18 crore rupees. Now you know that if I want to claim the exemption of this long-term gain, I can invest in another property. So you bought one more property in Delhi. So you sold one property in Mumbai. What was your long-term gain? 18 crores. So to claim the exemption of this property, to claim the exemption of this long-term gain of Mumbai property, you purchased another property within the given time in Delhi. The purchase cost of Delhi property was 20 crores. Is the purchase cost of the Delhi property more than 10 crores? Any purchase cost over and above 10 crore will be ignored. So investment 20, maximum investment 10, 20 or 10, whichever is lower, 10 crore. 10 crore or your capital gain, 18 crore, whichever is lower, 10 crore. So maximum exemption you can take 10 crore. Out of 18, 10 exempt, remaining 8 will be taxable. So the government does not want to give exemption above 10 crore under this section. Hence there is a restriction. In the investment of the property. Government is not directly telling you that see maximum exemption available will be 10 crore. No. If they will tell you like this, everyone will understand, no? Directly they will not say. Indirectly they are saying, okay, whatever capital gain is there, we are going to exempt the full gain. But remember, exemption is available based on investment in new property, yes or no? So investment in new property over and above 10 crore will be ignored. Indirectly up to 10 crore investment can only qualify for exemption. To the extent of 10 crore only you can take the exemption. Getting my point? What if your property, Mumbai property long-term gain was 18 crore. Mumbai property long-term gain was 18 crore and the cost of another property, for example Delhi property was 12 crore. So you were thinking that, okay, I was able to purchase for 12 crore. So out of 18 crore, I have invested 12 crore. I will get the exemption of 12 crore. Remaining 6 crore will be taxable. No. 12 crore investment is still more than 10 crores, no? So any investment over and above 10 crore will be ignored. So 12 crore or 10 crore, whichever is lower. Investment up to 10 crore only can be considered. And this investment up to 10 crore or your capital gain 18 crores, whichever is lower, 10 crore will be exempt. So you were thinking only 6 crore will be taxable, but no, here 8 crores will be taxable because any investment over and above 10 crore will be ignored. Will you remember this? Yes or no? This is the end of your section 54. Now pay attention. One small example I am taking up. Okay. Raj is having a residential house property. Assessee is Raj. Okay, no? Raj is having a residential house property in Pune. Pune is a city in Maharashtra. Okay. So that residential house property in Pune, which was a long-term capital asset. Holding period was more than 24 months. Now it was transferred on 19th of May 2025, and transferred for this much amount, this much brokerage, transfer expense, cost of the Pune property was this much. All those details will be given in the question. By using those details, first you will have to calculate this gain. So first they will tell you that no, we are not giving you the gain. First you calculate the gain. Gain should be the correct amount. Now in that same question, they will introduce the details of exemption also. So first they will tell you to calculate the gain. How will you calculate the gain? Calculation of the gain we have learned, no? Till yesterday we were doing that thing only. Calculating the capital gain, calculating the capital gain. So now do you know that how to calculate the capital gain of residential property? So the property is transferred in this year, 19th May 2025. And on the transfer, you computed the long-term gain. Because the property was a long-term capital asset and you calculated the long-term capital gain. Which capital gain? So long-term capital gain which you calculated, mind it, the long-term gain will be calculated without indexation. Why? Because the transfer is taking place on or after 23rd July 2024. Yes or no? On or after 23rd July 2024. So the long-term gain is now calculated. Without indexation. Okay. Now this long-term capital gain, which is without indexation, this long-term gain was, example, 15 crores. How much? Let's take 5 crores only. No, not 15 crores. Let's take 5 crores. So is the gain more than 2 crores? Is the gain more than 2 crore? Now investment in how many properties? Maximum one residential property in India. That option is not available for investing in 2 properties. That option is available only in the case of, only in case if this long-term gain is 2 crores or less. So is your gain 2 crores or less? No. More than 2 crores. So now investment in purchase, investment in construction of another property, meaning cost of another property, cost of purchase or construction of another property. Any one residential property will be assumed that it is made out of this gain. Understanding? So now tell me, for example, new residential house property purchased. Okay. So one property you purchased on 19th of June 2024. See, this is the date of purchase, huh? Can I say this is the date of purchase? So one purchased on new residential house property purchased on this date. Okay. The amounting to 3 crores, and this was in China. So purchasing this property for 3 crores in China. China is nearby, no, only after Ooty. Outside India. So investment in this property is made out of that gain. Will it be assumed that this 3 crore is made out of that long-term gain? No, this investment will not qualify only. Fortunate. See, this investment was made within 1 year backward. Within. So from the date of transfer, within 1 year backward, the investment was made. So investment was made very well within time. But the investment in the residential property was made in a property which is outside India, cannot qualify for exemption under section 54. You have to ignore this. Yes or no? Next one. On 20th July 2025. Can I say date of transfer of Pune property? After that within 2 years. After that within 2 years, or even before the due date of filing your ROI. Your due date of filing ROI will come on 31st July 2026. Even before that, on 20th July 2025, you are buying a new property. Yes or no? And that property you are buying for 4 crores in Uttar Pradesh. Can you buy one property in Uttar Pradesh? In India? Purchase price is 4 crores. Is it within 10 crores? So entire purchase cost can qualify. This cost can qualify, and it can be assumed that this 4 crore is met out of that 5 crore. And based on this, the exemption can be taken. Yes or no? So is it an eligible investment which will allow you to take the exemption? One more investment is done on 12th of December 2025. You are buying one more property for 6 crores. Investment is within 10 crores only, so full investment can qualify. Yes or no? And investment is also made within the time. See, from the date of transfer, after the date of transfer, within 2 years, even before the due date of filing your ROI, this investment is made. Yes or no? And this investment is made in a property in Jaipur. Jaipur is in India. So property is purchased in India. Yes or no? And the property is purchased for how much? 6 crores. So can I say in this 6 crore that long-term gain of 5 crore is also invested? So even this property is eligible. Now how many properties are eligible? 2 properties. Out of 2? Any one. Which one? Will you like to take 4 crores or you would like to take 6 crores? If you take 4 crores, no, it will be assumed that out of 5, only 4 is invested, remaining 1 crore will be taxable. Yes or no? But if you say that 6 crores, then entire 5 crore is invested, full 5 crores will be exempt. Yes or no? So which is better to take? 4 crore or 6 crore? Sir, we cannot take both, sir. Please, sir. No, because your long-term gain is more than 2 crore. Investment in 2 properties cannot qualify. Investment in only 1 property will qualify. Understanding? So investment in 1 property, we will consider 6 crore. Now tell me, if you want to calculate the exemption and the resulting taxable gain, how are you going to do? See, you are going to write down like this: long-term capital gain on transfer of what? Pune residential house property was how much, sir? 5 crores. Yes or no? Was how much? Out of this long-term capital gain, some long-term capital gain will be exempt. So that exempt amount will be reduced, no? And the balance long-term gain will be taxable. Getting my point? So less what? Exemption under which section? 54. Okay, sir. Now how much will be the exemption? Exemption will be the amount of long-term capital gain, which was how much? Or B, cost of new RHP purchased in Jaipur. How much was that? I could have written UP also. But writing UP will not allow me to take more exemption. Writing Jaipur will allow me to take more exemption. So how much? 6 crore. 5 or 6, whichever is. 5 or 6, whichever is. So tell me, 5 crores will be exempt. Meaning that in this 6 crore, 5 crore gain is, this entire 5 crore gain is invested, and accordingly, that entire 5 crore will be exempt. Because the property purchased is for a cost of 6 crores. In that 6 crore, this 5 crore gain is invested. So out of the cost, 5 crore cost is met by this 5 crore long-term gain. Hence, 5 crore long-term gain is exempt. Understanding? So how much will be the taxable gain right now? Nil. This time your taxable LTCG is equal to how much? Nil. Done. Now please pay attention. They are saying that this new residential house property, okay, no? When did you buy it? From 12th December 2025. For next 3 years. it cannot be transferred. So transfer of the Jaipur property is not allowed till 12th December 2028. Till 12th December 2000, you cannot sell the property. What if on 19th of November 2027, meaning within 3 years, Jaipur property is what? Sold for 9 crores. How much? Now tell me, when did you acquire the Jaipur property? 12 December 25. And when are you selling it? Within 3 years only, no? But within 3 years? No. Within 24 months only. Less than 24 months period of holding. Understanding? So, within 3 years, you are selling the Jaipur property. Now, when you will sell the Jaipur property in 27-28, so in the previous year 27-28, that is assessment year 28-29, will you calculate the capital gains of Jaipur property? So, capital gains on sale of what? Jaipur property will also be calculated. Now to calculate, what will be the full value of consideration? Selling price was 9 crores minus transfer expense dash, yes or no? Net consideration will be 9 crores minus, what was the cost of acquisition of Jaipur property? 6 crores, no? But out of that 6 crores, 5 crore cost was met out of the long-term gain, and to that extent of 5 crores, you have already claimed that exemption. So out of this 6, how much you have already claimed as exemption earlier? 5 crores. That will be reduced. Amount of exemption which you have claimed under section 54, that was rupees 5 crores, will be reduced from here. So we will not allow you to reduce the entire cost of 6 crores since you have sold the property within 3 years. So reduce only how much? 1 crore, and your resulting gain will be 8 crores. For example, if the entire 6 crore would have been allowed, how much would have been your gain? 3 crores. 9 minus 6, it would have been 3 crores. Now the gain is coming more. How much amount? 5 crores extra. This is the same 5 crores which we gave you as exemption earlier, will now be taxable as your capital gain. Understanding? Hello, sir. So this way the revocation will take place. Understanding? Now tell me, one more example I am taking. I am taking the same example, sir. Same example. Copy. Where you have a property? Guys, you had a property in Pune. Did you sell that property? Did you get long-term capital gain? How much? 5 crore. Okay. Now you are buying this Jaipur property. Okay, no? Eligible only. But the cost of Jaipur property was 2 crores only. Now tell me. Now the property in UP, the cost of that property is higher. So instead of claiming exemption up to 2 crore, it is better to claim exemption up to 4 crores. Yes or no? Entire cost of that UP property is met out of my capital gain. Entire cost of that UP property is met out of my capital gain. Accordingly, 4 crores will be exempt and 1 crore will be taxable. So how will you calculate here? See, long-term capital gain of which property? Pune property, that is 5 crore less exemption under section 54. How much will be that? A, the amount of your long-term capital gain, which is 5 crore, or B, cost of UP property, UP residential property, yes or no? That was 4 crore, whichever is lower, this 4 crore will be exempt. Yes or no? Meaning that entire cost is met out of this gain. And still 1 crore gain could not be invested, which remains will be taxable in this year. Understanding? Sure? Now for example, this UP property, you purchased on what date? You purchased the UP property on what date? Tell me. 20th July 2009 cannot be transferred within 3 years from this date. Yes or no? But what happened? On 9th of June 2026. 9th of June 2000, let's take 27 only. Can I say within 3 years from the date of purchase of this property, the property is sold. Now, sold for how much? Sold for 5.5 crores. How much? 5.5 crores. So now tell me, will you calculate capital gains? Capital gains on sale of which property? UP property. Okay. So this capital gain which you are calculating on the sale of UP property, you will calculate that in previous year 27, 28, assessment year 28, 29. Why? Because you are selling it in 27, 28, no? So what will be the full value of consideration? Selling price, which will be 5.5 crores minus transfer expense, which is dash. Net consideration 5.5 crores minus what? Cost of acquisition, which was how much? 4 crores. Yes or no? Out of this we will take back that amount which we have already allowed you as exemption. How much amount we have already allowed? Exemption under section 54. Entire cost of this we had allowed as exemption. So entire cost gone. Now how much cost remaining? Nil. Reduce nil and you are going to get 5.5 crores. This will be your capital gain. Which capital gain? Short-term capital gain. Why? Because the UP property was purchased on 20th July. 20th July 2025. From this date to this date, the period of holding is less than 24 months. So the resulting gain is short term. Yes or no? So this is known as revocation. This is known as revocation of exemption. And that will happen if the property is transferred within 3 years. Within 24 months? No, within 3 years. So even if the property is sold as long term later on, still the revocation will happen. Now see, in the first case, when I purchased this Jaipur property, you remember, no? This Jaipur property I purchased? Yes or no? When did I purchase that Jaipur property? And when did I sell it? So 12th December 2025 to 19th November 2027. The period of holding is less than 24 months. So this 8 crore was also your short-term capital gain. Understanding? And this is known as revocation. This is known as, how will you revoke? Did you understand? Sure, everyone? Now one small question should I ask you? Small question. Do you remember that Jaipur property we sold on what date? 19th November 27, no? Instead of that, we would have sold it on 27th of December 2027. Just this date is changing, okay, no? So tell me, is it still transferred within 3 years? But now if you will see that the period of holding is more than 24. Sold within 3 years. Revocation confirmed. Yes or no? Revocation will happen because it is sold within 3 years. Yes or no? But now can you see that the holding period is more than? So now here, instead of short-term gain, which gain will come? Now if you want to claim this long-term gain as exempt later on, Can you claim? Yes, this is the long-term gain on transfer of your Jaipur property, which is a residential property. Even the exemption under section 54 can be claimed for this property, provided you invest in another property within the given time. From the date of transfer of this Jaipur property, within 1 year backward, 2 years forward, another property was purchased. Within the 3 years from the date of transfer of this Jaipur property, another property was constructed. It will be assumed that the investment in that property is made out of this 8 crores, and still this 8 crore can be claimed as exempt, because this is now a long-term gain on transfer of your Jaipur property. Getting my point? Understood? Here also same thing. See, can you see when the property was transferred? 9th of June 2027, instead of this date. If it was 31st of July 2027. So now from here, date of purchase of UP property till the date of transfer of UP property, what is the period of holding? More than 24 months, but still it is transferred within 3 years. So now here the gain will not be short term, it will be, so this is the long term gain on transfer of residential property in UP. Can you claim the exemption for this property? Yes. Can you claim the exemption of this long term gain? Yes. Because this is a long term gain on transfer of a residential property in UP. When did you transfer that UP property? 31st July 2027. 1 year backward, 2 years forward. Another property purchased. 3 years forward, another property constructed. So investment in that property will allow you to take the exemption out of this 5.5 crore gain also. Understood? This is the end of section 54. Done, sir? Let's do one question. One question. Illustration number 11. Illustration number 11. Can you see this illustration? Guys, start. Start. You should get the answer by now. Very difficult question, huh? Difficult, no? Bloody, the gain you are calculating is a short-term gain of the property. Can you claim the exemption based on investment? No. It is available only if the long-term gain of residential property is there. So based on the investment of in the new property, you can claim the exemption of long-term gain only. Yes or no? So see, Mr. C purchased a residential house on July 20, 2023 for rupees 10 lakh and made some additions to the house incurring 2 lakh in August 2023. So can I say this is the cost of acquisition, actual cost, and this is the cost of improvement? Yes or no? He sold the house property in April 2025. Bloody, you are purchasing in July 23 and you are selling in April 25. The holding period is less than 24 months. Okay. So the capital gain will be short-term gain. So 20 lakh is the full value of consideration. Minus, what is the transfer expense? No transfer expense given. Net consideration will be 20 lakh. Minus cost of acquisition 10 lakh. Minus cost of improvement 2 lakh. You are going to get a capital gain of 8 lakhs. So 8 lakh rupees of capital gain is not a short-term gain, sorry, not a long-term gain, it is a short-term gain. So even if out of the sale proceeds of the old residential property, you have spent rupees 5 lakh to purchase another house property in September 25, meaning you have purchased within 2 years forward. Date of transfer was April 25. Within 1 year backward or 2 years forward, you have to purchase a new property. So the new property, another property is purchased within 2 years forward, and it is also purchased prior to the due date of filing your ROI. Yes or no? So this investment of 5 lakh would have allowed you to take the exemption under section 54, provided the gain of the old property would have been long term. But since the gain of the old property is a short-term gain, hence the investment made in this property may not give you the exemption under section 54. So no exemption under section 54 will be allowed based on the investment of this new property. Why? Because the gain arising on transfer of original property is a short-term gain and not a long-term gain. Yes or no? Now in that same question, write down. Here, you can see the blank space, no? Use this space. What would have been your answer? What would have been your answer if the old residential house property was acquired on 20th July 2022 instead of 20th July 23. So just you have to change this date. Which date? Date of purchase of old property, instead of 20th July 23, you just take it 22 now. Now tell me. Now the gain will be long-term gain, yes or no? And from that long-term gain, can you claim the exemption under section 54? Why? Because new property is purchased within 2 years from the date of transfer of the old property. Yes or no? And based on that, you can claim the exemption. Calculate. Gain will be same, 8 lakh only, no? But it will be long term now. It will be long term. And out of that gain, can you claim the exemption? Yes. So less exemption under section 54. Underline. A, long term gain, 8 lakh. B, cost of purchase of the new property, which is 5 lakh. 8 lakh or 5 lakh, whichever is, 5 lakh will be exempt and the balance 3 lakh will be taxable. That's it. Understanding? Homework for you today. Okay. Now come to the test your knowledge section. Test your knowledge section 1 after till question number 4 we have solved all the questions. 5 and 6 are pending, no? And then after that all the questions we have solved. Come to question number 5. Come to question number 5. Mark this question important, good question. This question is there in your ICI study mat. for the first time. Start solving this question. Question number 5. Test your knowledge. See, Mr. Satak entered into an agreement with Mr. Jai Kumar to sell his residential house located at Kanpur on 16th August 25 for 1 crore 50 lakhs. So this is the sale consideration. This is the date of transfer. And Mr. Sarthak is the assessee who is transferring the house. Okay. How he is getting the sale proceeds? Sale proceeds were to be paid in the following manner. 20% through account pay bank draft on the date of agreement, 60% on the date of possession, and balance after the completion of the registration of the title to the property. So this way the entire 1 crore 50 lakhs will be paid. Okay. Now Jai Kumar was handed over the possession on 15th of December. So agreement was made on 16th of August. Yes or no? And possession was given on 15th of December. And the registration happened on 14th of January. On all these 3 dates, the stamp duty values are given. So stamp duty value, all the stamp duty values are more than your sale consideration. But which stamp duty value you are going to take? Date of possession you don't have to take only. Either date of sale agreement or date of registration. Usually we take date of registration. But we are not going to take this, we are going to take this. Why? Because as on the date of sale agreement or before that, part of the consideration is received through prescribed mode. Yes or no? Hence the stamp duty value will be 1 crore 70 lakhs. So 1 crore 70 lakhs is more than 1 crore 50 lakhs. Yes. Difference is 20 lakhs, which is more than 10% of 1 crore 50. Hence 50C will apply. Sale consideration will be ignored and stamp duty value will be deemed to be your full value of consideration. Yes or no? So what is the full value of consideration? 1 crore 70 lakhs is the full value of consideration. Any transfer expense? 1 crore 70 lakhs. Any transfer expense? No. So net consideration will be 1 crore 70 lakhs. Guys, please check your answer. Huh? Okay. Then cost of acquisition. See, they are saying that Sarthak had acquired the residential house at Kanpur on 1st of April 2001. So he acquired the Kanpur house on 1st April 2001 and he has transferred on 14th January 2026. Date of registration is considered as date of transfer. Yes or no? So from the date of acquisition till the date of transfer, the holding period is more than 24 months. Yes or no? Hence the Kanpur property is a long-term asset, and long-term asset, long-term gain we are calculating. So what will be the cost of acquisition? 30 lakhs. We are going to reduce that 30 lakhs entirely without any indexation. Why? Because even if the property was purchased prior to 23rd July 24, but it is transferred on or after 23rd July 2024, the capital gain will be calculated, long-term gain will be calculated without indexation. So we are calculating without indexation cost, entire 30 lakhs without any indexation. Then 1 crore 40 lakhs will be your long-term capital gains. Everyone got this 1 crore 40 lakhs? This is a long-term capital gain. This is a gross long-term capital gain. But out of this, now you are going to get the exemption under section 54. Because see, Sarthak is also investing. After recovering the sale proceeds from Jai Kumar, he purchased 2 residential house properties. How many residential properties? One in Kanpur for rupees 20 lakhs on 24th of March 2000. Meaning, from the date of transfer, you have to count 2 years. 1 year backward, 2 years forward. So within 2 years forward, even before the due date of filing your ROI, another property in Kanpur was purchased for 20 lakhs. So this is an eligible property, eligible investment based on which you can claim the exemption. And also another property in Delhi for. So this property you have purchased in India, cost is 35 lakhs, yes or no? And this property is purchased on 28th of May. Within 2 years forward, even before the due date of filing your ROI. This property is also purchased. So this is also purchased within time. So within time, how many properties in India you have purchased? 2. So both the properties investment can be considered for exemption. Why? Because the capital gain is less than. Assuming that Sarthak had not exercised this option earlier, now in this year, Sarthak can exercise this option and claim the exemption under section 54 based on the investment in both the properties. Yes or no? So how much is the total investment? 20 lakhs, 35 lakhs, 55 lakhs. So cost of new residential properties in Kanpur and Delhi, 20 plus 35, is assumed as if it is made out of that 1 crore 40 lakhs, and based on this, the exemption will be available from 1 crore 40 lakhs. So 1 crore 40 lakhs or 55 lakhs, whichever is lower, 55 lakhs will be exempt. And how much will be taxable? 85 lakhs will be taxable. Understanding? Go and check the final answer. Are you getting 85 lakhs or not? Understood? How much is the capital gain chargeable to tax? 85 lakhs, no? Did you have that answer? See, 85 lakhs, final answer. Question number 5 now. See, 85 lakhs, final answer. Now, in this question, if they tell you to calculate the tax liability, which they have not told you, yes or no? But what if they tell you? Write down in that question. Go to the question and write down. Also calculate the tax liability. So tell me, first of all, what is the name of the assessee? Mr. Sarthak. Individual. ROR. PAN. Dash. Previous year 25, 26. Assessment year 26, 27. And computation of capital gains. So for this computation of capital gains, first you are going to take full value of consideration. For this we'll prepare a working note. Okay, no? No, we will do here only. Full value of consideration, your sale consideration, which is how much? 1 crore 50 lakhs, which is less than stamp duty value 1 crore 70 lakhs. For this we are going to write one note later on. Okay, now why we took 1 crore 70 lakhs. Okay, the difference which is equal to 20 lakhs and which is more than 10% of 1 crore 50 lakhs. Yes or no? Therefore 50C will apply, and in that case SDV to be taken as full value of consideration. So in the amount column, how much full value of consideration should I write? 1 crore 70 lakhs. In the amount column I am writing 1 crore 70 lakhs. In the particulars column, this entire working I will do. Now less transfer expense dash. So net consideration is 1 crore 70 lakhs less cost of acquisition. What was the cost of acquisition? 30 lakhs. So gross LTCG is how much? 1 crore 40 lakhs less exemption under section 54. So exemption under section 54, A or B, whichever is lower. A, LTCG, which is 1 crore 40 lakhs. Or B, investment, meaning cost of new residential house property in Kanpur and Delhi. 20 lakhs plus 35 lakhs. Both the investments we are taking. Yes or no? Which is equal to 55 lakhs. This or this, whichever is lower. So 55 lakhs is lower. That 55 lakhs will be allowed as exemption. So now taxable LTCG under section 112 is how much? 85 lakhs. So if you solve till here, you will get 6 marks. Understanding? Now on this taxable LTCG, this is taxable LTCG, right? No? 2 notes you are supposed to write down. Write down first note. Note 1. What note you are going to write? SDV as on date of sale agreement 1 crore 70 lakhs is considered under section 50C since what? Part of the consideration is received by way of prescribed modes on or before such date of sale agreement. Done, sir? So that is the reason why there we have taken what? 1 crore 70 lakhs. Understanding? Note number 2. Tell me, what will be note number 2? What will be note number 2? Come on, tell me. Investment in both the properties is considered to claim the exemption. So, investment in 2 residential house properties in India is considered, 2 means both the residential properties in India is considered to claim what? Exemption under section 54 since long-term capital gain on transfer of old RHP in Kanpur is less than is not more than 2 crores. Assuming this option was not exercised by Mr. Sarthak earlier. Understanding? So based on this, we have taken the investment in both the properties. Okay. So here you write down note number 1. Note 1. Give the reference to note 1 here, and here give the reference to note 2. Okay. Now write down computation of tax liability. Tax is also to be calculated, no? Tax on long-term gain under section 112. Come on, tell me. How will you calculate? First, LTCG without indexation. As above. How much was that LTCG? 85 lakhs only, no? After claiming exemption and all. So tax at the rate of 12.5% will be how much? 10,62,500. This is your tax 1. Now what are you going to do? LTCG with indexation. And guys, now this long-term gain you are going to calculate with indexation. The calculations remain same. Calculation remains everything. But instead of cost of acquisition, you are going to write index cost of acquisition. Right now? So no need to write all these things again. Just write 1 crore 70 lakhs. No need to write all these things. Because that you have already written earlier. So net consideration will be 1 crore 70 lakhs less index cost of acquisition. So what was your cost of acquisition, friends? 30 lakhs. Yes or no? Into CI of which year? Transfer year. 25, 26. That is 376 divided by CI of acquisition year. Which was the acquisition year? 1, 2. So CI is 100. Calculate. 1 crore 12 lakh, 8,000. Got it everyone? 80,000. 80,000. Reduce that. 57 lakh. So can I say now this is your gross LTCG? Now from this gross LTCG, are you going to take exemption? Yes. So if the exemption would have been taken from this amount, so this is the same thing which you are supposed to write there also. Exemption you are supposed to consider, no? Understanding or not? So take the exemption now. So what will be your gain? 2,20,000. And this gain is with indexation and after claiming the exemption. That was without indexation after claiming the exemption. This is with indexation after claiming the exemption. Understanding? So tell me, this 2,20,000. Hello, 2,20,000. Now on this you are going to calculate tax at how much? 20% rate. Calculate. 44,000. This is your tax 2. So therefore tax on LTCG under section 112 shall be lower of what? Tax 1 and tax 2. That is equal to 44,000. Will you pay 10 lakh rupees tax? Or you are satisfied with 44? Pay 44 only. Understood or not? In that same question, the tax liability on this gain would have been asked. This would have been tax liability. Done, sir? Sure? One section is over, 54. Now see, all the other sections are just a piece of cake, I told you. Now tell me here, everyone, pay attention. 54. What was section 54? You sell residential property, you transfer residential property, and you invest in another residential property. You will get the exemption. Now everything remaining same. 54B is there. Which section? Now what this section says? This section says that you are an individual or HUF, but now you have transferred what? Transferred urban agricultural land. Which land you are transferring, sir? And on transfer of urban agricultural land, either as your short-term capital asset or your long-term capital asset, the capital gain will arise. That capital gain can be short-term capital gain or long-term capital gain. Short-term capital gain as well as long-term capital gain. You can claim the exemption of this gain under section 54B. How much exemption you are going to take? A. Amount of your short-term capital gain or long-term capital gain as the case may be. And now you have to purchase. You have to make investment. Where? Which type of asset you transferred? Urban agricultural land. So now which type of asset you will buy? Any agricultural land. It can be urban, it can be rural. So you are supposed to invest in new agricultural land. So invest means you have to incur the cost. Invest in purchase. Invest in agricultural land. Agricultural land can be urban or it can be rural. It can be any. Invest means you have to purchase any agricultural land in China, only in India, and this purchase should happen within 2 years forward. 2 years time has been given. How much time? So whatever agricultural land, whether any agricultural land, they are saying any agricultural land is purchased within 2 years after the date of transfer of original land. So your original land was urban agricultural land. Date of transfer, after the date of transfer within 2 years. You are supposed to purchase any agricultural land in India. So amount which you have invested in purchase, meaning purchase cost of the new agricultural land, whether urban or rural, is met out of your capital gain. So we will assume as if the cost of purchase is met out of your capital gain of urban agricultural land, and accordingly based on that investment in the new agricultural land, you can claim the exemption from your capital gain. Understanding? So instead of residential property to residential property, it is what? Urban agricultural land, the gain is invested in new agricultural land. Yes or no? Now purchase should happen within this time. So within this time, whatever land is purchased, it will be assumed that it is purchased out of the capital gain. And based on this investment, based on the cost of this land, you will get the exemption. How much exemption? Either the entire gain or the cost, whichever is lower. Yes or no? If the cost is more, entire capital gain will be exempt, assuming that the entire gain is invested. If the cost is equal to capital gain, then if the cost is equal to capital gain, then entire capital gain is invested, entire capital gain is exempted. What if the cost is less? Investment is less, then to that extent your capital gain will be exempt and the balance will be taxable. Now don't you think this 2 years time is not a small time? It is a long time. And before the expiry of this 2 years, the due date of filing ROI will come. And in that ROI, if you want to claim the exemption of this gain, you will not be able to claim if you have not purchased the agricultural land on or before the due date of filing ROI. So will you get that CGD option here also? The answer is yes. So here also you will get that option of deposit. Deposit in what? Deposit in CGD account, capital gain deposit account, and this deposit should be made on or before. On or before what? On or before the due date of filing ROI, due date of ROI, or actual date of filing the ROI, whichever comes earlier. On or before that date, you are supposed to deposit the amount. Where? In CGD account. So the amount deposited in CGD account, we will assume as if your capital gain only is deposited. Yes or no? And based on that also you are going to get the exemption. Now you know that the amount which will be withdrawn has to be used for what? Purchase of agricultural land only. Yes or no? Whether rural or urban, within the balance period of 2 years. What if within the balance period of 2 years, the amount is not used for purchase or construction? It is misutilized. What happens on misutilization? You know that. And 2 years expire, now still some amount remaining in CGD account. What happens with that unutilized balance? You very well know that. What happens? Deemed LTCG. Misutilization, deemed LTCG. Do I have to talk about that again and again? Or once done, it is applicable everywhere. Wherever the CGD will come, the same discussion is going to be happening. Yes or no? So I'm not again and again going to tell you that. Okay? Now next one, the new agricultural land. The lock-in period of new residential house property was 3 years. So the lock-in period of new agricultural land will also be 3 years. Within 3 years from the date of purchase of the new agricultural land cannot be sold or transferred. Yes or no? If you do that, then the capital gain which was exempted under section 54B in the cost of that new agricultural land will be revoked. And how do you revoke? Reduce that amount of exemption under section 54B out of the cost of that land whenever you are going to calculate the capital gain of that land. Yes or no? Understanding? So if you have transferred the new agricultural land within 3 years, so will you calculate the capital gain of the new agricultural land? Yes. That time the cost of that new agricultural land, out of that cost, reduce the amount of exemption which you have already claimed under section 54B. So the cost which you have already claimed as exemption under section 54B, to that extent the cost will not be allowed. That cost will be reduced. But this will happen only if new agricultural land was urban. Only then you are going to calculate the capital gain. Only then the revocation will happen. What if the new agricultural land was rural? Based on that investment also you have got the exemption, no? And if the rural agricultural land is sold within 3 years, no revocation will happen because that is not a capital asset only. Understanding? So in the new agricultural land you have invested, and that new agricultural land is a urban agricultural land. Which? Urban agricultural land. If that is sold within 3 years, then revocation will happen. Then amount of exemption under section 54B will be reduced out of the cost of the new urban agricultural land at the time of calculating the capital gain. But what if the new agricultural land was rural? What if the new agricultural land was rural? Based on the investment in the new agricultural land, you have got the exemption. Even if it was rural, and even if you transfer that rural agricultural land within 3 years, still there will be no revocation. Why? Because new agricultural land is a rural land. Even if transferred within 3 years, it is not a capital asset. No capital gain has to be calculated. And if there is no capital gain calculation, revocation will not take place only. Understanding? Understanding? And there is no restriction. that the maximum investment has to be 10 crores. If the capital gain is up to 2 crores, investment in 2. No. Here there is no restriction. Purchase of as many agricultural land as you can. All the agricultural land, total investment in the agricultural land has to be considered. Yes or no? And that investment can be up to any amount. Understanding? So this is comparatively more easier as compared to 54. 54 was a little bit tricky and this is easier than this. Did you understand this? 54B over. Now coming to 54D. Which section? Now pay attention, 54D. 54D talks about the exemption, and this exemption will be available to any person. Now this is the first exemption which is not applicable in the case of individual HUF only. This will be applicable in the case of all assessees. All assessees can take the benefit of this exemption. So any person, in the case of any person, transfer of any land or building or land and building which was used for what? Industrial purpose. Which purpose? So its transfer is taking place, and the transfer is taking place by way of compulsory acquisition only. So if you will sell, capital gain will come, cannot be exempted. That will be taxable, fully taxable. No exemption for that gain. Yes or no? But if the compulsory acquisition took place, so on compulsory acquisition, are you going to calculate the capital gain? Under section 45(5). Under section 45(5). That gain can be short-term gain also. That gain can be long-term gain also. That gain can be exempted under 54D. That gain can be exempted under section 54D. So the transfer of this industrial land or building, should be by way of compulsory acquisition. And this industrial land or building is used for industrial purpose for at least how many years? 2 years. Immediately prior to its compulsory acquisition. Yes or no? So, are you any assessee? Yes. You have a land or building. Land, building or land and building which you were using for industrial purpose. Have you transferred it? Yes. But the transfer has taken place by way of compulsory acquisition. And this industrial land or building or land and building is used for industrial purpose for at least 2 years immediately prior to its compulsory acquisition. So on this transfer, will you calculate capital gain? And now that capital gain will be calculated under section 45(5). Capital gain will be calculated under section, and that capital gain can be short-term capital gain or it will be long-term capital gain, and this will be exempt. Exempt under section 54D. But to take this exemption, you will have to invest. Where you are going to invest? New land, building or land and building. Purchase of new land or building or land and building. Construction of new building for industrial purpose. Yes or no? Or you can also deposit in CGD account because the time will be within 3 years. Within the 3 years from date of transfer, no? Compulsory acquisition, no. The date of compulsory acquisition is not the year in which the gain is taxable, is not the year of compulsory acquisition. It is the year of receipt of insurance claim, if you remember. So in which year this gain will be taxable? In the year of compulsory acquisition? No. This gain will be taxable under section 45(5) in the year in which the compensation or any part thereof is received for the first time. So that period of investment in the new land, new building has to be counted from date of transfer, date of compulsory acquisition. No, that period of 3 years has to be counted from date of receipt of compensation. Do you remember the first case? Residential property to residential property. Hello, sir. Residential house property compulsorily acquired. Residential house property compulsorily acquired. Long-term gain can arise there. And that long-term gain will be as per section 45(5). If you want to claim the exemption of that long-term gain under section 54, you have to make an investment within 1 year backward, 2 years forward, or 3 years forward. But that period will not be counted from date of transfer. That period will be counted from the date of receipt of compensation. Do you remember urban agricultural land? Urban agricultural land transferred and the investment of new agricultural land has to be made within 2 years forward. That 2 years time you count from date of transfer. But what if there the compulsory acquisition is taking place? So urban agricultural land compulsorily acquired, capital gain you will calculate under section 45(5). And to take the exemption out of that capital gain, you have to invest in the new agricultural land within 2 years from the date of compulsory acquisition. No, from the date of receipt of compensation. Understanding? So wherever you are calculating capital gains under section 45(5), wherever you are calculating capital gains under section 45(5), that capital gain if you want to claim as exempt, yes or no? So the investment in the new asset should not happen within the given time. The investment in the new asset should happen within the given time. But that given time has to be counted from date of transfer, no. Date of compulsory acquisition, no. Date of receipt of compensation. Because in that year only that gain is to be taxed. Not in the year of compulsory acquisition. And by the way, as on the date of compulsory acquisition, you don't have the capital gain realized. So how will you invest that? Getting my point? So there is one section. Which section? 54H. Which section? So what that 54H says? See, that section 54H is there. I'm going to write down that section. Here I will write. That section 54H says that if capital gain on compulsory acquisition is to be claimed as what? Exempt. Then to claim exemption of such capital gain, investment in new asset is to be made within the given time. So that given time, within the given time, which is to be ascertained. Based on date of transfer. No, it's to be ascertained based on date of receipt of compensation. So 1 year backward, 2 years forward, date of receipt of compensation. 3 years forward, date of receipt of compensation. For urban agricultural land, 2 years forward, 2 years from the date of receipt of compensation. And in this section also, they are saying that if you want to claim this exemption, you have to buy new industrial land, new industrial building, yes or no? Or you have to construct new industrial building, that purchase or construction should happen within 3 years. But that 3 years should be counted from, 3 years will be counted from date of transfer, date of compulsory acquisition. No, date of receipt of compensation. Got it, sir? As per 54H, that is applicable for all these sections. Getting my point? So tell me, 54D, exemption under section 54D will be how much? The amount of your short-term capital gain or long-term capital gain which you have ascertained under section 45(5), or B, amount of investment in new land or building or land and building for industrial purpose. Investment means cost of purchase. So you have to purchase or you have to construct. What you will purchase? Purchase of land or building or land and building. For what? Industrial purpose. And that purchase should happen within 3 years. 3 years from the date of compulsory acquisition. From the date of receipt of compensation. 3 years from date of receipt of compensation. 3 years forward. Yes or no? And you have to construct. Construct what? Land building. Will you construct land? So you have to construct building. Building for what? Industrial purpose. And this construction should also be completed within 3 years. 3 years from the date of receipt of what? Compensation. Getting my point, everyone? Hello, sir? Now 3 years time is a small time frame or a big time frame? Possible, no? That before the 3 years are expired, your due date for filing return will come. Due date for filing return for which year? The year in which your capital gain under section 45(5) will be taxable. That is the year in which the compensation is received for the first time. In that year, the capital gain will be taxable. So the due date of filing ROI of that year will come. And on or before that due date, you are not able to purchase, you are not able to construct. So can I say CGD option can also be given here? So deposit in what? CGD account. And that deposit should be made on or before. On or before what? Due date of ROI or actual date of filing ROI. Yes or no? Whichever is earlier. And this due date of ROI or actual date of filing ROI for which year? For the previous year in which capital gain under section 45(5) is what? Taxable. Understanding? So now let's take one small example. See, this is a timeline. Okay, no? 1, 2, 3, 4. Okay. This is your previous year. This is the previous year 24-25. Can I say on 9/9/2024 compulsory acquisition took place here? Yes or no? So the capital gain will be taxable in 24-25. Which year the capital gain will be taxable? The year in which the compensation is received for the first time. Yes or no? So for example, in the previous year 25-26. Compensation is received. Compensation is received on 19th of June 2025. So this is the date of receipt of compensation. And the compensation is received in 25-26. So the capital gain will be taxable under section 45(5). It will be taxable under section 45(5). In which year? In the year of compulsory acquisition? No. It will be taxable in the year of receipt of compensation. Yes or no? So from this date you are supposed to count how many years? 3 years. So not from the date of compulsory acquisition, from the date of receipt of compensation. Yes or no? So 1 year, 2 year and 3 year. Can I say 19th of June 2028? So within this period of 3 years, whether you have to purchase or you have to construct what? Industrial, land, building or land and building. Within this 3 years, the purchase or construction should get over. Now what if before these 3 years, the due date will come? Due date of filing? ROI of which year? ROI of 25-26, in which the gain is taxable. ROI of the year in which the in which the compensation is received. So the year in which the compensation is received, what was the due date of filing the ROI of that year? Due date will be 31st of July. On or before the due date of filing ROI of this year in which the compensation is received, on or before this due date, you have to deposit in CGD. Getting my point? Hello, sir. So whatever deposit made, whatever purchases made, based on that, you can claim the exemption. CGD deposit, amount withdrawn, has to be utilized in the balance time for what? Purchase or construction. If that amount is withdrawn, misutilized, you already know. Amount is withdrawn, amount is still appearing on the expiry of 3 years as unutilized balance in CGD account. That unutilized balance, what is to be done? You already know. And the lock-in period of the new asset, from the date of its purchase or from the date of completion of its construction, the lock-in period of that new asset will be 3 years. What if within 3 years that new asset is transferred? Then the exemption given under section 54D will be revoked. And how that will be revoked? Simple. Whenever you sell that new asset, you will calculate the capital gain of that new asset. Out of the capital, while calculating that capital gain, will you reduce the cost? Yes. Out of that cost, the exemption under section 54D will be reduced. That much cost which we have already allowed under section 54D, we are not going to allow you that again. Understood? Everyone? Same thing. Everything is same. But the only trick is this capital gain 54D is not a normal capital gain. It is a capital gain on compulsory acquisition of your industrial land and building, which was used for at least 2 years prior to its compulsory acquisition for industrial purpose. So whatever capital gain is now coming, short term or long term, that you are going to calculate under section 45(5), that capital gain is exempted under section 54D. Yes or no? And to claim that exemption, you have to invest in new industrial land or building. And that investment will allow you to take the exemption under section 54D. Understood or not? Sure, sir. 54D over. Now see, there is no restriction that capital gain is up to 2 crore. You can invest in these many properties only. No. There is no restriction. You can purchase as many land, as many buildings you can, but you have to purchase within this time. Yes or no? And maximum amount of investment should not be more than 10 crore. That restriction is also not here. Understood? No? Did you understand 54H? Now, same logic you have to apply in the case of conversion of capital asset into stock in trade. Same logic you have to apply in the case of receipt of insurance claim. Can you have a capital gain on conversion of capital asset into stock in trade? Yes or no? That capital gain will be calculated under section 45(2). Even that capital gain can be exempted, no? Hello? Under section 54 and 54B. Under section 54 and 54B. Even that capital gain can be exempted. But to claim that exemption, you have to invest within time. So that investment within time, that time has to be counted from the date of transfer. Yes or no? So for this case, it will be counted from the date of transfer, meaning date of conversion. No. Date of sale of stock in trade, because in that year the gain will be taxable. Understanding? So just like this, the gain is not taxable on compulsory acquisition, so ignore the date of compulsory acquisition. Gain will be taxable in which year? The date of receipt of compensation. Count the period of investment from this date. Yes or no? And in the case of 45(2), the capital gain is there on conversion of capital asset into stock in trade. For that case, the gain is not taxable in the year of conversion. The gain is taxable in the year of sale of stock in trade. So if you want to claim exemption from that gain, then investment should happen within the given time, not from the date of conversion, from the date of sale of stock in trade. That is CBDT circular. What if insurance claim is received on damage or destruction? The gain is taxable in the year of damage or destruction? No, the gain is taxable in the year of receipt of insurance claim. So if the gain is taxable in the year of receipt of insurance claim, and if you want to claim the exemption of that gain, so for that you will have to invest in the new asset. And the investment in the new asset should happen within given time. But which is to be counted from the date of damage or destruction? No, it has to be counted from the date of receipt of insurance claim. Yes or no? So I am giving you two more notes over here. Okay, no? If any capital gain on if capital gain on conversion of capital asset into stock in trade is to be claimed as what? Exempt. Yes or no? Exempt. Then to claim such exemption claim exemption of such capital gain, to claim exemption of such capital gain, investment in new asset, investment in is to be made within the given time, which is to be ascertained based on, based on date of transfer, date of conversion, no, date of sale of what? Stock in trade. From this date you are going to count the time to invest in the new asset. 1 year backward, 2 years forward, 3 years forward, yes or no? That time we are going to count from the date of transfer? No. Date of date of conversion into stock in trade? No. We are going to count it from date of sale of stock in trade, because the gain will be taxable in the year in which the stock in trade is sold. So to claim the exemption out of that gain, the investment should be made, investment in the new asset should be made within the given time from the date of sale of stock in trade only. Common sense. Yes or no? Hello, this is CBDT circular. One more circular is there. Tell me. Now what circular? Same to same. If the capital gain is to be blah 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 blah. Yes or no? Copy. Now here, instead of conversion of capital asset into stock in trade, what I will write? If the capital gain on what? Receipt of, on receipt of insurance claim on damage or destruction of what? Capital asset. If you want to claim this gain as exempt, then to claim the exemption of such capital gain, investment in new asset is to be made within the given time, and that time to invest in the new asset is to be ascertained based on which date? Date of transfer, date of damage or destruction, or date of receipt of insurance claim. Date of receipt of insurance claim. Yes or no? Because the year in which the gain will be taxable is the year of receipt of insurance claim. Yes or no? So to invest in the new asset, you should count the period to invest in the new asset from which date? From the date of receipt of insurance claim. Understanding? And this entire 3 discussions which I have done, no? Not from the date of transfer, from the date of receipt of compensation, from the date of sale of stock in trade, from the date of receipt of insurance claim. This entire 3 discussions are applicable for all these sections except 54D, where only compulsory acquisition is applicable. Yes or no? Will you remember this? So this was your 54D. Now only 2 sections are remaining, 54EC and 54F. 54EC, very easy. Very easy. Sir, 54EC, exemption under section 54EC will be available to which assessee? Any assessee? Sure. So any person can take the exemption. Individual, HUF, company, any person can take the exemption. But that person who is taking the exemption, first he has to transfer. He has to transfer any immovable property. Any immovable property means land or building or land and building. Any immovable property he will transfer. And that immovable property is transferred as what? Long-term capital asset. And that will result into what? Long-term capital gain. And that long-term capital gain can be exempted under section 54EC. Now how much exemption can be taken? How much exemption can be taken? A, amount of your long-term capital gain, or B, investment in another immovable property. No. Now you have to invest the long-term gain of immovable property in notified bonds. So if you have purchased notified bonds within given time, then we will assume that the investment in that bond is made out of this gain. And we are going to give you the exemption. Understanding? So now you have to invest in notified bonds. Notified. So investment in the purchase of notified bonds. Now which bonds are notified? Bonds of NHAI, bonds of RECL, bonds of PFC, IRFC. Now 2 more bonds have been notified from this year. New bonds. Yes or no? IRDEA, IRDEAL, and one is HUDCO. Full forms are there in your ICI study mat. Okay, read that. Okay, now see these notified bonds you are supposed to purchase. These notified bonds you are supposed to purchase. Purchase. Why purchase? Because you cannot construct bonds, no? You have to only purchase. Okay, no? So you will be purchasing these notified bonds within how much time? Within 6 months. 6 months forward. 6 months from the date of transfer. So the date on which you have transferred your immovable property, from that date, within 6 months you have to purchase. Sir, but my immovable property was not transferred. It was compulsorily acquired. Then 6 months from the date of compulsory acquisition. 6 months from the date of receipt of compensation. Sir, my immovable property was converted into stock in trade. So 6 months from the date of conversion. 6 months from the date of sale of that immovable property as stock in trade. Yes or no? Sir, my immovable property was damaged or destroyed. Then 6 months from the date of damage or destruction. No, 6 months from the everywhere. In all these sections you are supposed to apply this logic. Getting my point? So, within 6 months forward means date of transfer. After that, 6 months. Within that 6 months, you are supposed to purchase the bonds. 6 months time is a big time or a small duration? Big duration or a small duration? So, the duration is small, huh? Don't expect us to give you the benefit of CGD here. You will deposit the amount in CGD, then you will withdraw, and then from that you will buy the bonds. Bloody, if you have to buy the bonds directly, no? What is the need of depositing in CGD? That CGD deposit is required if you want to purchase any property, etc. Yes or no? The CGD benefit we are not going to extend for all exemptions. Especially for 54EC, where we are telling you to invest in what? Bonds. Go and directly invest in the bonds. No, the amount which you want to deposit in CGD, that amount can be directly invested in the bonds. Then go and invest in the bonds only, instead of depositing in CGD. And the 6 months time is a very small time. For that, you should not be given the benefit of what? CGD. Getting my point, everyone? So tell me, within 6 months forward. So, CGD account deposit in CGD account, allowed or not allowed? Not allowed. Understanding? Not allowed for 54 EC. Okay. Now purchase of notified bonds within 6 months. The bond should be of NHAI, RECL, PFC, IRFC, IRDAL and HUDCO. Any of these bonds of any of these institutions you purchase. So whatever amount you have invested in the purchase of these bonds will be considered as if the long-term gain of your immobile property is invested. So long-term gain of immobile property is invested in these bonds, okay. Based on that, you will get the exemption of that long-term gain of your immobile property. Yes or no? But remember, investment in the bonds, maximum 50 lakhs. Any investment within 6 months, and that investment is more than 50 lakhs, excess investment will be ignored, and maximum investment for 54 EC in the bonds cannot be more than 50 lakhs. So for example, your long-term gain of immobile property was 80 lakhs. How much? So to get the exemption of 80 lakhs, what you did? You purchased some bonds. And bonds you purchased 75 lakhs. So you thought that okay, 75 lakhs bonds are purchased. It will be assumed that out of 80, 75 lakh is invested. So to the extent of 75 lakhs, my gain will be exempt. I will pay tax only on 5 lakhs. You were thinking like that. What the government said? Any investment in the bonds over and above 50 lakhs will be ignored. So how much you have actually invested? 75. Is it more than 50? Excess 25 will be ignored. So 75 or 50, whichever is lower. Maximum investment 50 lakhs. Yes or no? That 50 lakhs for your capital gain 80 lakhs, whichever is lower. How much exempt? 50 lakhs. So out of 80, 50 will be exempt, and the balance, you were thinking that only 5 lakh will be taxable, but no, 30 lakh will be taxable. Why? Because to claim the exemption, you made the investment in the bonds, and the investment in the bonds was more than 50 lakhs. So any investment over and above 50 lakhs will be ignored. Will not be considered for exemption under section 54 EC. Will you remember? CGD option available, not available? Sure. Lock-in period of the bonds? 5 years. For all the other sections, the new asset, lock-in period was how many years? 3 years. Here the lock-in period will be 5 years. So the new bonds, the bonds which you have purchased based on the investment of this bond, have you got the exemption under section 54 EC? Yes. These bonds should not be transferred within 5 years. Neither they can kept as security to get a loan within 5 years, and neither they can be converted into money, meaning they are not redeemable within 5 years. Converted into money within 5 years means what? You purchased the bond, they were redeemed within 5 years. So the year in which you transfer, or the year they are converted into money, or the year in which you are keeping them as a security to get a loan, in that year, whatever exemption we have given you under section 54 EC will be deemed to be your long-term capital gain. That way the revocation will happen. No need to adjust from cost or anything like that. Yes or no? Like the way in which we were doing earlier. In earlier 3 section, how revocation was done? We used to reduce the amount of exemption out of the cost of the new asset. Yes or no? Here you are not supposed to do the revocation like this. Whatever amount of exemption was availed under section 54 EC, no, that entire amount of 54 EC we will charge as a deemed long-term gain in the year in which either you have sold the bonds or bonds are kept as security to take the loan or the bonds are converted into money, meaning they are redeemed. Yes or no? If this thing happens within 5 years, if any of these 3 things, defaults happen within 5 years, any of these 3 defaults happen within 5 years. So the year in which this default is done, in that year, whatever exemption we have given under section 54 EC, based on the investment of these bonds which you are selling, based on the investment in these bonds which you are giving as a security to take a loan, that amount of 54 EC exemption will be deemed to be your long-term capital gain. With this, section 54 EC over. Now there is a small doubt. Should I ask you that doubt? Sure. Long-term gain of which property? Any immovable property. Can it be a residential house property? So residential house property is there. Long-term gain of residential house property can be claimed as exempt under section 54 EC. There is no restriction. If it was not allowed, they would have given any residential any property, any immovable property other than residential. Have they told you other than residential property? No. So even the long-term gain of residential house property can be claimed as exempt under section 54 EC. That can be claimed as exempt under 54 also, and that can be exempt under 54 EC also. Which property they are saying? Immobile property. Which immobile property? Urban agricultural land is also an immobile property. So can you have long-term gain on transfer of urban agricultural land? Can you claim the exemption of that under section 54 EC? Yes. It is nowhere mentioned that the immobile property can be any immobile property other than urban agricultural land. Even the urban agricultural land, long-term gain can be exempt under section 54 EC. That can be exempt under 54B also. That can be exempt under 54B also. So long-term gain of urban agricultural land, investment is made in agricultural land, will allow you to take the exemption under section 54B. Long-term gain of urban agricultural land, if the investment was made in bonds, will allow you to take the exemption under section 54 EC out of this gain. Getting my point? Long-term gain of residential property. Long-term gain of residential property, if the investment was made in another residential property, that investment will allow you to take exemption under section 54 out of this long-term gain. And if the investment is made in notified bonds, that investment in the notified bonds will allow you to take the exemption out of this long-term capital gain under section 54 EC also. There is no problem. So now tell me, long-term gain of residential property can be exempted under section 54 also. Long-term gain of residential property can be taken under 54 EC also. But for that, different investments are to be done. Yes or no? If investment done in residential property, then 54. If investment is done in notified bonds, then 54 EC. Likewise, long-term gain of urban agricultural land can be exempted under 54B also and can be exempted under section 54 EC. If you want to claim 54B, then invest in another agricultural land. If you want to claim exemption under 54 EC, invest in bonds. Understanding or not? But now the problem will arise. During the given time of 6 months, you have invested in the bonds also. During the given time, you have invested in residential property also. Both the investments are done. So do you have a residential property? Yes. Have you transferred it? Yes. Have you got the long-term gain? Yes. Now out of this long-term gain, you can take section 54 exemption also because you have invested in residential property also, and from this long-term gain you can take 54 EC exemption also because you have also invested in notified bonds. Can you take both the exemption from this gain? Yes. There is no restriction. Some gain you can exempt under section 54 and some gain you can exempt under 54 EC. Likewise, some gain you can exempt under 54B, some gain you can exempt under 54 EC. There is no restriction on that. Getting my point? But now tell me, which exemption you will claim first? Will you claim 54 and then balance in 54 EC? Will you claim 54B first and then balance under 54 EC? Or will you claim 54 EC first and then balance under 54 or 54B? Understanding what I am trying to tell you? Always claim specific exemption first. Residential house property, long-term gain was there. Have you invested in residential property? Claim section 54 first. And whatever balance remains, balance long-term gain remains, that you claim under section 54 EC. Do you have a long-term capital gain on transfer of urban agricultural land? Yes. Have you invested in agricultural land? Yes. Claim 54B first. And then whatever remains, that you claim under section 54 EC. Because see, if some investment out of notified bonds will remain, no, which could not be claimed as exempt here, it can be claimed as exemption from long-term gain of any other immovable property. But if some investment out of residential property or urban agricultural land will remain, agricultural land will remain, that cannot be taken as an exemption from any other immovable property. For example, you have a residential house property. Which property? Okay. So now tell me, residential house property you have transferred, okay, old residential house property you have transferred and the long-term capital gain was there. Example, the amount of long-term capital gain is 80 lakhs. Now this year, no, you have invested in new residential house property also. This investment is made within the time and you have invested in notified bonds also. This investment is also made within time. Okay, no? Now see, investment in the notified bonds was 60 lakhs. Sorry, it was 40 lakhs. Okay, and investment in new residential property was 50 lakhs. Possible? Even this can be exempted from this gain. Even this can be exempted from this gain. Can you claim both the exemptions from this gain? Yes. But which one will you claim first? Will you claim this 40 lakh under 54 EC first? Or will you claim this 50 lakhs under section 54 first? Always claim 54 first. Then whatever remains, you claim from 54 EC. Why I am saying? See, if the long-term capital gain was how much? 80 lakhs. And out of that, if you are taking exemption of section 54, how much is exemption? 80 lakhs or 50 lakhs, whichever is lower. So how much will be exempt? 50 lakhs. Okay. So can I say entire investment of property, new residential house property, entire investment in new residential house property could be claimed as exemption. No investment remaining. No investment in the new residential property remaining unclaimed. Entire investment in the new residential property could be claimed as exemption. So no wastage of investment. No wastage of investment. Now how much capital gain still remains? 30 lakhs. And out of this, if you claim 54 EC. So what will be 54 EC? The balance 30 lakhs. Capital gain or investment. How much? 40 lakhs. Whichever is lower. So 30 lakh exemption will be there. What will be the taxable gain? Nil. So there will be no taxable gain. There will be, but can you see that out of 40 lakh of investment in bonds, the benefit of only 30 lakh can be taken as exemption? 10 lakh investment in the bonds is still cannot be claimed as exempt from this gain. But that you can very well claim from any other long-term gain of any other immovable property. Because investment in the notified bonds, yes or no, based on that investment, long-term gain of any immovable property can be claimed as exempt. So this 10 lakh which could not be claimed from here, yes or no, from from the long-term gain of residential property can be very well claimed as an exemption from the long-term gain of any other property. But this cannot be done if that 10 lakh was remaining from residential house property investment. What if we would have done reverse thing? What was my capital gain? Tell me. Long-term capital gain was 80 lakhs. Long-term capital gain was 80 lakhs. Out of that, if instead of 54, I claim 54 EC. So, 80 lakhs or 40 lakhs, whichever is. So, I will claim 40 lakhs first. Okay. How much capital gain will remain? 40. And now out of this, if I claim 54, then 40 lakhs or investment in new residential property was 50 lakhs. Whichever is lower, I will get 40 lakhs. Yes or no? Still the taxable capital gain is nil. But don't you think out of 50 lakhs, I was able to claim the exemption of only 40 lakh cost? 10 lakh cost, 10 lakh investment of the residential property is getting wasted. Now that 10 lakh investment cannot be claimed as exemption from any immobile property. Getting my point? So it is always better to claim specific exemption first. 54 first. Then whatever remains, claim from 54 EC. Getting my point? Because if any investment in the notified bonds will also remain, no. That investment can later on be claimed as exemption from any other immobile property, which is not possible in the case of if you save this investment. Because this 10 lakh rupees of investment in the residential property cannot be claimed from here. Only up to 40 can be claimed. So what about the balance 10 lakh of investment in the residential property? Can I say that investment is made out of the long-term gain of urban agricultural land? And even if I say I'm not going to get any exemption for that. Understanding? So specific exemption first. And if you don't remember this logic, no, which section comes first? 54 or 54 EC? Claim 54 first. Then 54 EC. Which section will come first? 54B or 54 EC? Claim 54B first, then 54 EC. If you don't remember the logic. Understanding? Sure. 54 EC, done. Now, question is there. Go to question. But wait, take a small break. After the break, we'll continue. Okay? Take a break.